Thanks for joining us today on Market Call. I'm Morella Fernandez. Colin Cieszynski on the show with us today, Chief Market Strategist at SIA Wealth Management. He'll take your questions on technical analysis. Here's how to reach us. Call us toll-free, 1-855-326-6266. You can email your questions as well, marketcall@bnnbloomberg.ca. Colin, good to see you. Thanks for coming in.
Oh, thanks, Marilla. It's good to see you.
North American market still diving today. Typically, this time of the year is stronger. Clearly, that's not happening. Is this the start of a correction? Is there more of a correction to come, you think?
It looks like we're into a correction now. It's interesting because we have a world heat map, and I was just looking at it. And in the last week, I looked on Monday, and it was kind of a mix of green and red. And then looking today, it's like on the 1 week, it's all red. So it's been a really broad-based sell-off everywhere, and kind of overdue because we had the 6-month period of the year from May to October when markets are usually weak. We're incredibly strong this year. Seasonality's gone off a little bit. The times that are usually strong have been weak, like in the winter, and then when it's weak, it's been strong, like in the summer. And now that we're heading into what's historically a stronger period, we're getting some weakness and we're getting a correction. But to me, it's just a case of the markets have pretty much gone straight up for 6 months.
Yeah, what do you think has aligned to make it happen now?
I think what we're seeing on a news basis is we're getting to the end of some news things. We've got the U.S. government shutdown is over, and perhaps more importantly, earnings season is over. And this isn't unusual. We see this in the summer, that oftentimes the summer correction we get right after the end of earnings season. And now we're seeing it again here kind of right after the end of earnings season. It's when there's less corporate news flow and things start to go quiet and people go, maybe I've had a good run here and I'll start to take some profits.
What's your take on earnings season as we've seen it so far?
So far, it was actually pretty good. But what I do think we're running into now is in some ways, their earnings season was great. Earnings were good. We had a few misses here and there. We've had one this morning with Home Depot.
Yes.
And we had Netflix a few weeks ago and the odd big name here and there. But for the most part, it was pretty good. But I think what's happened now is that all the earnings are out and everybody's stepping back and going, okay, well, let's take a look. And they're, valuations are looking a little stretched. And again, maybe it's time to lighten up a little bit because we probably won't get any significant news now for probably till the new year. Things do start to quiet down over the next 6 weeks or so.
Although NVIDIA, of course, reports tomorrow.
Yes,
tech stocks started that drag down. They started off before anybody else. Are you seeing tech-connected sectors also being dragged down?
We are, because we're seeing the interesting one that I noticed over the last week was utility stocks. And utility stocks, a lot of them had boomed on the notion that AI is going to mean tons of computing demand, which means tons of power demand. So a good example of a secondary or tertiary sector that normally you look at this and you say, well, utilities are low beta, they're low volatility. Well, not now. Some of them have had quite a lot of volatility in both directions. They had huge rallies, and now some of them have had some pretty big corrections.
And precious metals.
And precious metals as well. So they've had their own run here. And precious metals have benefited from the fact that the U.S. dollar has had its worst year since the early 70s. And now what we're seeing is the U.S. dollar starting to bottom out. And we're hearing rumblings from the Fed of we might not cut interest rates in December. We'll see if they do. But the market's kind of 50-50 on that one, whereas a few months ago it was, of course they're going to cut in December. Well, maybe not. And so now we're seeing the U.S. dollar come back. And that's also kind of put a headwind in front of precious metals, commodities, and even equities.
Okay. Let's take a quick break. We will line up some phone calls and emails for Colin Cieszynski of SIA Wealth Management. He'll take your questions on technical analysis. Here's how to reach us. We're back in just a moment. Stay tuned. Welcome back to Market Call, and thanks for joining us. We're going to start with an email today from Carl, who says, can you give your analysis on Cenovus Energy? Cenovus, of course, Colin took over MEG Energy, incorporated that first time trading. MEG has disappeared this week, and now it's Cenovus. Let's take a look at the Cenovus chart. We've got the 1 year up now. What can you tell us?
Well, this has been acting really well. And something I wanted to just frame this and speak to in general, energy stocks have been doing really well on a relative strength basis lately. We have had a change in leadership. And we've seen we've seen weakness obviously in tech, in industrials, in AI and adjacent sectors. But some of the sectors that have actually been attracting capital and doing well in this period have been financials, defensive like healthcare, and the other one, energy.
Okay.
Energy stocks, and it's been really interesting to watch because energy's done well despite the fact that the oil price is going nowhere at 60. But nice accumulation here, steady uptrend, not going crazy, just steady improvement, higher highs, higher lows. Really nice rising channel here. It is testing resistance here up and around. It's around 25.50, but so far that's a really nice looking chart.
Are you noticing similarities for natural gas and oil, or are you noticing sort of stocks that are more natural gas not coming up as much?
Gas has actually been doing okay.
Okay.
It's we're in a seasonally favorable period for natural gas because home heating season is coming, and so natural gas tends to do well between early September and middle of February,
okay,
give or take. And especially if we have something like where it snowed here last weekend,
yeah,
that's always good for gas.
Which snow came early this year. All right, yes. Let's go to Chris then. Chris is on the line. He's in Delta, BC with a question. Hi, Chris.
Good morning, Morella and Colin. Thank you for taking my call. Colin, I'd like to ask you about Pembina Pipeline and maybe natural gas investing in general. I'm a 29-year-old long-term, hopefully, knock on wood, investor. And I'm also a leverage investor using eligible dividend Canadian-paying companies for that. And I usually approach the selection of those names through fundamental analysis. And so if you wouldn't mind, I'd appreciate any words of wisdom on incorporating leverage, technical analysis, anything in that realm. Thank you so much. I will hang up and listen.
Okay, thank you for that question. We have the chart up for Pembina Pipelines. We'll take a look at that. And we'll continue the conversation we just started about natural gas. You said it's a better time. Typically, when it's colder, natural gas will pick up. That being said, we are seeing some of the prices of natural gas be kind of sticky, right? It's not really gaining. People are saying, hold on to this for a longer term. But what's your take on the space?
Yeah, so natural gas, I tend to look at it as more of a seasonal play than longer terms because it's hard to tell what's going to happen with supply and demand from year to year over the longer term. I struggle a bit with that, but so I look at it as more of more on the seasonal type of basis for natural gas. But I would say to our caller that if you are looking at trading on a leverage basis, you absolutely want to be using technical analysis. You want to be using stop losses, because if you're trading on leverage, that can amplify both your gains and your losses. So if you're going to play with leverage, you need to be able to manage your risk because you don't want to take big losses. And so therefore you need to have some kind of a stop loss. And usually the stop losses are better derived using technical analysis.
Okay, take a look at Pembina. Tell me what you see. It looks pretty volatile from my end.
It is. It's had some pretty big swings here in a range between about 48 and 58. Had an upswing, has come off. But what I like about this chart here is we call it reversal of polarity. And if we look at 52, it came down, bounced off it as support, broke it, became resistance. Then from like May to September, it stayed under 52, it was resistance. Since then, it broke out, became support, one test in September, rallied up, came back on another correction, has bounced right off of it, off support again here in early November. Looks like it's on an upswing, initial resistance in the 58 to 60 range, which is kind of the top of this longer one-year range that we've had going on so far this year. So it looks like you've had a pullback within a range. You're bouncing off support and it's going on an upswing. Not a bad thing.
All right. That was Pembina. Let's move on to Joseph in Montreal with a question today. Hi, Joseph.
Good day. Thanks for taking my call. Yeah, as you noted, seasonality is not what it should be. The home builders are supposed to be doing pretty well right now in the U.S., but not so. I'm looking at D.R. Horton, DHI in New York, and we're in what I think could be a cup and handle formation. So it's come off a little bit from its highs back in the late summer and the fall there. For cup and handle formations, first of all, is that something you believe in? Are you one of those that like such a pattern? Because we're below the 200-day moving average, but that handle might be forming now. as volumes are decreasing, hopefully will increase soon. So I want to get opinion on cup and handles, and how does D.R. Horton look right now? Thanks.
Okay, thank you for the question. High was in the summertime at 184.04, down to 137.39 today. Cup and handle.
Yeah, so the cup and handle is a long-term bottoming pattern where you have a large rounded bottom and then a smaller, often higher rounded bottom. And in this case, you certainly can see the cup part here between December and August, and that it looks like that. So there's your cup, and or some people will call it a saucer. And regardless, so that was a beautiful breakout pattern to there. What concerns me is that in the last few months, yeah, you're getting a deeper cup here, and in particular, what concerns me about this is that you broke under 150. 150 was your breakout point back in August, and as we showed on the Pembina chart, where it bounced off of that, here it didn't. It broke 150, and it's continued to trend lower, and that concerns me that you could see it come back into its previous trading range, which was more like 120 to 130 was the previous zone back here, and so that concerns me that you may end up potentially technically back into that area. So it looked like it was forming a cup and handle. It looks like it's kind of failing here, having broken 150, and it is concerning still at this point in time. We're still in a downward trend of lower highs, and we haven't seen any bottom yet. And perhaps part of what's weighing on this might be going back to we were talking about the Fed, and that the Fed has kind of been making noises that they might not cut interest rates in December. And that's the kind of thing that could drag on housing stocks.
Yeah, and they make construct single-family homes. Okay.
Yeah, one more.
Go ahead.
Sorry, one more little thing I would mention on that also was that Home Depot, when they put out their earnings this morning, said the housing market was soft.
Yeah,
So
Home
that's the
Depot
other-
thought people would be coming in now that the rates did actually go down, and they thought they'd get people running in the door because they've been holding off on projects until now, and they said it hasn't materialized. So clearly people are waiting to see what happens next. Let's go to another caller. Rocco's on the line. He's in Montreal with a question. Hi, Rocco.
Yes, hi, good afternoon. My question is on New Flyer NFI. This is not for the faint of heart. Stock hit 20. I should have got out, would have covered my losses, but now we're back down to 13. I know they have a lot of supply chain issues, but what is your feeling on New Flyer? Thank you.
Okay, thank you for the question.
Thanks.
There's the chart. Wow. Quite a climb from sort of the start of the year.
It sure did. But what's important here, I think, is that we can see that we had from February through May, you had kind of 3 months bottoming process. From, say, the middle of July to the middle of September, you had about a 2 month of topping process. And so this is a stock that does seem to take a little bit of time it forms rounded tops and bottoms rather than V tops and bottoms. And so I would say to this one right now, it still looks like it's under distribution. We're still seeing lower highs. Your first support would be back probably around this 12 breakout point, and then maybe a little closer to 10. And so what I would suggest at this point in time is it just doesn't quite look ready yet, and it may take a little while to bottom out, as we've seen from previous trading.
So a gradual decline, and you're hoping it bounces off the 12.
Yes.
Got it. Okay. I hope that is good. Let's move on to take a break. We will be back with more questions for Colin Cieszynski of SIA Wealth Management in just a moment. Stay tuned. Welcome back, and thanks for joining us today. Let's go to Stuart on the line, I think, in Picton. Sorry? Sue, I'm sorry. Sue is on the line with a question. Hi, Sue.
I'm calling about Constellation Software. Colin, I thought that I was so lucky to be able to buy Constellation at a 20% sell-off around 4,000. Obviously the wrong move, so I'm wondering, where's this stock going? Thank you.
Yeah, Constellation Software, you know the business model for that company, and there are concerns about software and the future of software. So it's tanked quite a bit over the last couple of months. When you look at that chart, what do you see?
It's still struggling. Could we please go out to a 3-year chart on this just to get some more context on it, please? Thank you.
Okay, so it's down 27% in the 1 year. We'll pull up a 3-year right now.
Yes, so.
And there we go.
So I would say on a relative strength basis, we owned Constellation Software was a stock we owned in our portfolio in the early part of this year. And as it started to lose relative strength, it fell down in our rankings and reached the point where we sell stocks, and so we sold it. And we replaced it with something that was higher ranked. But this is something we've seen, and it's not just particular to Constellation, is if we look at the tech sector, people often look, oh, well, tech is tech, right? No, it does make a difference. And sometimes internet does better, sometimes software does better, sometimes hardware does better. And right now, we're in this phase where semiconductors have been ruling the roost. But in fact, general software has actually, as we've seen, not been doing well for several months now. And it's not just Constellation, it's the software sector in general. And so software stocks are continuing to struggle. It looks like, so at 32.20, it looks like next support is probably around the 3,000 round number. And then we can see if we go back to 23, there was some pretty good support in and around 27.50. And so at this point in time, it doesn't look like it's bottomed out yet. It looks like it's still struggling and under distribution. Sorry.
Wow. Okay. So I hope that helps you make a decision. It's not great news, but I hope it helps you make a decision as we move on to Todd, who's on the line in Niagara Falls today. Hi, Todd.
Hey there, Colin. Appreciate your expertise and always learn something listening to you. My call is about MDA Space.
MDA Space has been a struggle. This is a stock, we've owned this stock twice in our portfolios this year, and it's been really, really hard one to own because it has these massive runs, and then it has these big collapses. And it's, as we can see it's had two. In fact, it's had three. It had one back in the winter, back in January. And then it had this one here back in August.
But this particular collapse now is
and this one really concerns me because we're now back at 21. So we're at a point where previously it has attracted support. But again, we can see with this one, it took from February to June for it to bottom out. So it was about 4 months. So it's a case where in this particular, it may take several months for this to bottom out, for people to believe that this stock has bottomed out, because it has been incredibly volatile over the course of the last year. So we don't own it now. We did get knocked out when the relative strength came off of it back in September. And the other part that worries me is when you look at something like this, there's a pattern that's often called a triple waterfall, and this is two. So it does concern me. If this stock breaks this kind of 21.20, it could have one more. I'm concerned it could have one more down leg in it.
Okay.
And
so when you're talking to people and you say perhaps if it breaks that 2021 and goes down again, basically they have to hold on because it looks like that drag down isn't sort of a straight line down. It's going to take some time. And if they're prepared for that, then that's okay.
Yeah, I mean, in our case, we look at relative strength and we concentrate in areas that are showing relative strength. So we avoid stocks that do not have relative strength. As I said, we sold MDA Space, and we would not get back into it until it has bottomed out and shown relative strength. Because one of the things as technical analysts we look at is, for example, if you lose 25% on something, it's a 33% gain to get you back to break even. If you lose 50% on something, it's a double to get your way back to break even. So there's as technicians and as relative strength analysts and risk managers, we say to ourselves, there's a time and a place for a stock and to be in it, and there's a time and a place to not be in it, because if something is just drifting and it's not working out, then your money as an investor is perhaps better placed somewhere else that's working for the time being. And certainly keep an eye on stocks you like and be in them when the time is right and when they're struggling.
What did you see and when did you decide to get out of MDA?
MDA, both times it fell in our rankings right after the sell-offs.
Okay.
So one in January, it dropped about. The first one in January was the first sign that their contract in the States might be in trouble.
Okay.
And then the second one was when they actually lost it.
That contract.
And so when they lost the contract, and it's things like that as well, where something loses a contract or some major negative development like that, then oftentimes you'll see it in the charts and it will drop in the chart, it will drop in the rankings. And then for us, it's just a time to let it go and move on.
Okay. All right, let's move on then to Kevin, who is in Ottawa with a question today. Hi, Kevin.
Thank you for taking my call. I've been watching CNQ, Canadian Natural Resources, for a long time, and I decided to step in about a month ago. I noticed the last 3 months it's been consistently moving upwards, like most of the oil stocks. And so I'm kind of glad I got in. Do you see it continuing to move up? Because its 3 months chart seems pretty promising. Thank you.
Okay, so let's take a look at where it is. It's 47.28 today. The high for CNQ was last year in November at 48.71. So it's $1 and change off at this point. But the movement has been slow.
It's slow. It's slow and steady. Could we please see a 3-year on this one?
Okay, we'll pull up the 3-year chart. You said you see some strength in energy these days.
I have seen strength. We are seeing strength in energy stocks are generally improving, and that's quite intriguing. So as we look here, we look at this and we say this here was $45, and over several months, you're absolutely right. We saw steady improvement, steady accumulation, consistently higher lows. We've broken out over 45. That is a pattern called an ascending triangle, and it's a bullish pattern, and you're on a breakout. You've already broken out of this downtrend of lower highs. You did that earlier in the year. So this actually looks really good right now, technically. First resistance around 48, around the $50 round number, and here that's, call it 52, 50, 53. So this looks like it does have some potential upside on the technical basis. It's been acting better and it's breaking out.
Okay, so that looks good for CNQ. Then let's move on to Sophia. She is calling from New Brunswick today, Shediac. Hi, Sophia.
It's Sylvia.
Oh, I'm sorry. Thank you for calling. I have Sophia at my prompter, so we'll correct. Sylvia, how are you?
I'm fine. Good afternoon. I've been watching Hudbay Minerals for a little while, and I'm thinking of investing, and I'd like your opinion, please.
Okay.
So thank you for taking my call.
Thanks for the call. Let's take a look at that chart and bring it up for Hudbay. It's up almost 76% on the year, up a little bit on the day, about 2%, and sitting at 21.13. What do you see in Hudbay?
I am a little concerned about this one. And the reason that this has been a nice stock, it's had a really good run. We had it accumulate. It's had a big run. It ran from 15 to almost 25. And we can see on the 1-year basis, it's up 75%. So it's had a pretty big move here. What concerns me, and we have seen this a bit with metal stocks, is we're getting a bit of a correction now. And we've seen the correction in the price of gold. The price of copper, it has stalled out. And we are seeing, what concerns me about this stock right now is this, that you've had here at 2 runs at 24 and it's been unable to get through, is what we call a double top, and it hasn't, it's concern.
Where do you see the floor? At about 20, a little above 20?
Yeah,
there?
a little above 20, 21. We're probably sitting on it. But what concerns me at the moment in this kind of a general pullback is if this thing takes out 20, it could drop back to 15. And so at this point in time, it's a stock that has a run. It looks like it's gone into a sideways trend, but at this point in time, there's a risk that it could break down and go further. So what I'd be watching for is, I'd be just watching something like this at the moment to see, does it continue to hold these gains? Does it continue to hold 20? Does it continue to show that it's kind of stabilizing in this 20 to 25 range? On the other hand, if it did break out 24, all systems go, but if it takes out 20, it's in big trouble. And it's kind of sitting in that wishy-washy kind of consolidation kind of zone at the moment. So that's why it concerns me for somebody that would be looking at this as a new investment, chasing into something that's already had a big move and looks like it might be topping.
So if you've gained from it, maybe trim at this point to see if it does sort of get closer to the 20 and keep creeping down.
Yeah.
Okay. Sylvia, I hope that is good for you. We're going to take a quick break. We are going to look at past picks from Colin when we come back. Welcome back. Time now to go through past picks from Colin Cieszynski from March 24th of this year. At the time, he chose Agnico Eagle, AEM, on the TSX. It was 149.19. Of course, gold has had an incredible run this year. So it's at 234.91, 57% upside, 58% a total return. So this was in March, ahead of Liberation Day. What made you want to get in or recommend gold through Agnico at this point?
Sure. So at that point in time, the price of gold was rallying. It was starting to break out. The gold stocks were all at the top of the relative strength rankings. They were all winning their head-to-head battles. And as we went down the list, the golds were right up at the top, and we owned the gold stocks in our portfolios, and we still do, and we still own Agnico, even through the correction we've had, because the correction we had in gold stocks was fairly moderate, and we can see, yes, it's pulled back, but it also has kind of stabilized here above 225. So at this point in time, this stock continues to act well, and we still hold it in the portfolios. It's still a winner on relative strength basis.
Okay, good to know. Let's get to your next past pick. T-Mobile in the U.S., TMUS on the NASDAQ. It was $258.96 U.S. at the time. So this was March 24th of this year. It's down to $216.22. So 16% drop return, 16% total return drop. What's been going on with T-Mobile, and do you still hold it?
We have sold this one back in the spring, in about May.
Okay.
And what happened was, at the time, was we saw the relative strength start to deteriorate. So we can see January, February, this was a stock where when the markets went volatile and people got cautious and defensive, they went into stocks like T-Mobile. And it did really, really well back in the winter. And then once the markets bounced back and it started to recover, then you had this slow drip downwards. Bit of a recovery, and then you had another round down here. Now, what's interesting is, in the last week or so, since the volatility has picked up and tech has started to come off, some of the defensive areas have started to pick up again. Now, so this one's early, and as I said, this is something that we rotated out of. It lost its relative strength. It fell down the rankings. It's still down in the rankings, but we have seen other defensive areas pick up, as I mentioned, things like energy, healthcare.
Is this a stock you would consider repurchasing?
If it came back up in the rankings, yes. If it did, if its relative strength was to improve and markets were to remain volatile, it's something that we would consider if it got back up into the higher part of the rankings.
Okay, let's get to your third pick then from March of this year. BMO's MSCI, the China Selection Equity Index, ETF, ZCH on the TSX, 1946 at the time, 2181 today, so 12% upside for return and total return. What do you like about the China selection? What's included in that umbrella?
It's got a lot of the biggest large cap China names, so it's one that we still hold in the portfolios, and it has done really nicely. We can see since it bottomed out in April, just steady accumulation. The upward momentum has slowed a little bit more recently. It's kind of gone into a bit more of a sideways range between about 20 and 24, but this has continued to act well. China has continued to act well on a relative to a lot of other countries this year, and so far so good.
So you're holding on to it, you said?
Yes.
Got it. Good to know. Okay, we're going to take another quick break. We will line up some more phone calls and emails for Colin Cieszynski. He's taking your questions on technical analysis. Here's how to reach us. Back in a moment. Welcome back, and thanks for joining us on Market Call. Let's go to Jerry. He's on the line in Toronto with a question. Hi, Jerry.
Hi, Morella. Hi, Colin. My question is about Magna. I've actually probably the longest held position I have. I've had a very long time, and I missed the really big downdraft in it. I am kind of looking at unloading it at some point. I'd like your opinion on a technical basis, whether you think I should hold on to it or what point would be good to sell it at. Thank you.
Thank you for that, for the question, Jerry. Magna, of course, hit by all the tariff action in the U.S. It did a drop down, but it's steady climb forward since that. What do you see in the 2-year chart here, or 3 years, excuse me?
Yeah, so this is actually starting to show some signs of life. And Magna is a stock that's underperformed, as you've mentioned, for quite some time. It's been hanging around the bottom of our Canadian relative strength rankings for quite some time. But it does look like it's starting to show some signs of life. It's broken out of this downtrend here. And interestingly, it's broken out of this downtrend at a time when it's under the threat of tariffs. So almost like the markets are kind of looking past it now.
Okay.
Or starting to. Like there's still concerns, there's still risks, but it looks like a lot of the worst of the risk was already priced in, and the stock has started to quietly recover. And it's actually been breaking out lately. So this is looking more encouraging. And more importantly, and I'll note this within the larger context, is the auto sector has started to do better lately. I've talked about how some stocks have been, some sectors have been coming off like tech, but other sectors have been starting to do well and attract capital. And one of them is the auto sector. And the auto sector has been so beaten down for so long, and it's starting to come back, and it's looking intriguing here.
Okay, good to know. I hope that helps Jerry out. Let's go to an email from Steve. He says, thoughts on Fairfax Financial going forward. So I've got the chart up for Fairfax Financial at 23.79, 23.80 is what I have, up $21 today, almost 22, and up 24% on the year. Did that sharp pullback with everybody else in April, but wow, it shot up since then.
Absolutely. So this is a stock that we owned actually for quite a long time. And like we owned it for over a year. It was a really nice stock that we did really well with for a long period of time. We actually sold it back in October here when it had this pullback. It dropped far enough down in the relative strength rankings that are so we do rules-based trading, and our rules kicked it out. And when our rules say sell something, we sell it, and then we ask questions later and we come back and figure it out. But anyways, in this case, it came off, and it's had this nice bounce up off of 2,200, which is encouraging. And it looks like it's back in an upswing. Now, so far, this looks like it's in an upswing between what's emerging as a sideways trading range. So it looks like it's in more of a sideways trading range than an uptrend now, but it's on an upswing within that. So far, so good. Its resistance maybe around 2,400, which is an old support, maybe around 2,500, 2,550. We'd be keeping an eye on, but so far, so good. But financials is another area that has started to attract interest in the last week, and insurance companies. And the insurance sector had actually struggled for most of this year, and insurance has actually been underperforming the rest of the financials and the rest of the markets. And Fairfax actually was an exception. It was one of the last ones to actually go down. And of course we're seeing it's one of the first ones to bounce back. But that was nice. So far it's looking interesting, anyways.
Okay, let's go to Rebecca then. Rebecca's on the line in Halifax with a question. Hi, Rebecca.
Hi. Yes, I'm interested in looking for an entry point for Capital Power. It's been in a downtrend, but I think it's connected to the AI and data centers scenario that's happening in the market. But I'm wondering if it might go below 60 and even head to 55.
Okay, thank you for that question, Rebecca. It went down in April to 43.90, which everybody else did, but then it sort of went sideways for a little while through the summer before climbing back up. Right now it's at 62.65. Could it get a bounce off of that?
To me, it looks like the support might be around 60. We're seeing a couple of trend lines come together in and around 60, with the next support, as you mentioned, in and around 55. So right now, Capital Power is not trading like a traditional utility. It's some of the utilities, the power generators are, as we mentioned, are trading like AI off of the AI trade.
Yes.
And as we're seeing this correction in AI stocks, we're seeing a correction in semiconductors, and we're seeing it in utilities. And the market today, at least, is telling us that this might not be over yet. So at this point in time, you'd want to see something like we can see back in March, April, it kind of took a couple of months to kind of bottom out, show some support, and then went up. Even in August and September, mid-July to mid-September, you had a 2-month period where it stabilized and then launched into the next up leg. And I think at this point in time, we haven't even seen it start to stabilize yet. So it's probably a little bit early to be looking at it. It's had a nice pullback. And if the AA trade comes back on, this could do well, but it may need some time to digest the moves that it's already had.
Okay, so she might have room to pick it up, but further down.
Yes.
Got it. Okay, we're going to take a quick break. Back with Colin Cieszynski, SIA Wealth Management. Questions on technical analysis. Back in a moment. Welcome back. Time to go to Smita. She's in Woodbridge, Ontario, with her question for Colin today. Hi, Smita.
Hello. Thank you for taking my call. I have a question about Shopify. It is under correction in a short time, the trend is breaking. So what is the best, for short-term and long-term, the entry?
Sorry, short-term and long-term entry. Okay. Thank you for the question, Smita. Let's pull up the look. It's such a volatile stock. I sort of hesitate around this stock because it's so volatile. But tell me what you read into that line.
So first of all, what I would just show you here is Shopify has been breaking down on an actual basis. It's also been breaking down on a relative basis. So this one has come under quite a bit of pressure.
Explain the difference, please.
Oh, relative stocks relative to other stocks. So in the case, in this situation where a lot of stocks are going down, this one's going down more than most.
Got it.
So it's like, so there's stocks, you have the market going down, some go down more, some go down less. This one's going down more.
Okay.
So, and that's important because we've seen this trend line that had been in place since April has been broken. And the next support is around 180. But if we could switch to the 3-month chart, please. I wanted to show this. This is a head and shoulders top pattern. You had a shoulder here in early October, the head at the end of October. You had a shoulder here in mid-November. Your neckline was 210, and you have busted that. You've busted 200. I mean, this just looks awful technically right now. That is a major topping pattern that has been completed, and the stock has continued to decline. So at this point in time, it looks like it's started into an emerging downtrend.
Okay, and she's looking for an entry point, so she should hold off?
At this point in time, yes. It's a stock that, and it's also dropped way down the relative strength rankings as well. So there's other stocks and sectors that are outperforming right now.
Okay. All right, let's go to Wayne. He's in London, Ontario. He's got a question. Hi, Wayne.
Yes, hi, Morella. I'd like to ask your guest Colin about Atkins Realis Group. I'd like his opinion on the chart. It hit I guess about 105 back a little while ago. Now it's down around 85.73, which I believe is at the 50-day moving average, and it is above the 200-day. Anyway, just wanted to get his thoughts on where it might be going from here and whether or not he owns it or not.
Okay, thank you for the question. Atkins Realis has benefited from sort of the nuclear plans to build out and has done well, but has been going a bit sideways now, down. What do you see?
Oh, we see. So this stock has really started to break down. It is a stock that we used to own and that we had sold a few weeks ago, and it is because its relative strength was deteriorating. And not just Atkins Realis, but every single construction and engineering stock is doing this. They're all breaking down at the same time. This isn't just a stock play. This is a sector play. And it's kind of concerning you when you think the construction and engineering stocks are all breaking down one after another, after another, after another. It's a sign of distribution in the sector. And so we did see peaked above 105. We saw it come off and just consolidated through October. But yeah, in the last couple of weeks, the bottom's fallen out. It's taken out 90, peaked back above it and failed, and now it's gone to a new low. So this one looks like it's under distribution now. Next kind of major support is probably down in the 75 to 80 area. But we'll note back in the winter, it bottomed out kind of in the low 60s. So at this point in time, it looks like it's really been crumbling technically.
Okay. That is the look at Atkins Realis for Wayne. As we move on to Chris, who's in Calgary with a question. Hi, Chris.
Good morning. My question is with regard to Chemtrade Logistics Income Fund. Thank you.
Okay. Thank you for the question. We'll pull Chemtrade up now. Is this a stock that you have invested in the past?
No, we haven't held this one before. The stock has been... It looks like it's doing okay here. I mean, what I like about this stock, though, is it's what I call a step pattern. You get rallies, holds at a higher level, rallies, holds at a higher level, rallies. So you would now expect it to kind of hold at this higher level, 13, 14. So, I mean, it looks fine. It's just that it's one that's kind of like this longer term hold kind of play. But technically, that's a beautiful pattern.
Okay. So that is Chemtrade, which is at $13.99, just short of $14 today. Okay, that is all the time we have for your phone calls and your emails. But Colin has some new topics, and he'll share those when we come back. And join us tomorrow on Market Call. Tim Regan will be on the show, Managing Director at King West & Company. He'll take your questions on North American large caps. Time now for Colin's new picks. We're going to start with PowerCore, POW, on the TSX. What did you like about PowerCore?
Well, one of the things we've seen over the last couple of weeks, I mentioned, was we've had a lot of changes in relative strength and in stocks within the Canadian and U.S. relative strength rankings. Who's outperforming? Who's winning the battles of head to head between them? And so one of the sectors that we've seen attract renewed interest is actually the insurance sector, which is one that's underperformed for the last 6 months. Power Corporation, we can see, has picked up really nicely in the last week or so, and it has found its way to the top of the Canadian relative strength ranking. So it's number one. We own it in our portfolios, and on the basis it's number one. And we own the top ranked stocks, and it's been doing extremely well at it and holding in well at a time when other sectors have been crumbling.
Yeah, and it looks at the end of last year, sort of going a little bit sideways for a while, took that dip, and then had a steady climb.
Absolutely.
Okay, let's get to your next pick, which is Alphabet, a very well-known name, GOOGL on the NASDAQ. Alphabet, like some of the tech, was dragged down for a while, but had a major investment announcement, and so has been pushed up. Tell me what you like about Alphabet compared to the other, for example, Mag 7.
Yeah, absolutely. So what we've seen, a lot of volatility in the Mag 7 stocks, but Alphabet is the one that's held up really well. It's one that kind of normally hangs around the what we call the bottom of our green zone, top of our yellow zone, which is around the 25 through top 25% being green, and then 26 to 50 being the yellow zone, and it usually kind of hangs around the bottom of that. It's worked its way up, and it's worked its way up kind of into the top 10 of our U.S. relative strength rankings, and it's actually the highest ranked of the Mag 7 stocks right now. And I think what's happened is that it's a little less volatile than some of the others. It's a little lower beta. It doesn't have the massive swings that you get in a Nvidia or even in Amazon or Microsoft, the other ones.
Apple, Meta, anybody like that? Okay.
Yeah, they all tend to get bigger swings, whereas this one seems to be more of a steady Eddie kind of stock, and we're moving into more of an environment where the steady Eddie stocks are starting to outperform after underperforming for the last 6 months. So this has quietly percolated its way up, and it's been acting really well.
So did you take a new position in it recently?
We took a new position in this back in October. In October,
okay. And just out of curiosity, are you invested in the other Mag 7?
At this point in time, within the Mag 7, we do have holdings in Tesla as well.
Tesla, got it. Okay, let's get to your third pick, which we touched on earlier about car manufacturers, General Motors, of course, GM on the New York Stock Exchange. Also an industry that had a bit of a runaround with the tariffs and sort of what was produced in Canada versus what was produced in other parts of North America. What do you like about General Motors moving forward?
General Motors has been acting really well. And as I mentioned, the auto sector was a stock that's been really depressed, really beaten down for years and years and years. And then it started to move up and it started to break out. And it's not just GM. GM popped on earnings, and then a day later, Ford popped on earnings. And people are starting to take notice, and people are starting to, the auto sector is starting to attract attention again. And we go back to, I talked about Tesla. Tesla tends to attract attention pretty much all the time. But in this case now, all the rest of the automakers are starting to attract attention too. GM moved up recently after the earnings pop into the top 10 of our U.S. relative strength rankings, and it is a stock that we have in the portfolios, and it's just acting really, really well on a relative strength basis. And as I said, it's not just GM, it's the whole sector is doing.
I do want to ask you about Tesla because it's an interesting investment. People worry about valuations. That, of course, is super stretched. Why are you remaining invested in Tesla at this point?
Tesla's been on an upswing, and it has performed well. And I mean, as with a lot of the other higher momentum volatility stocks, it has pulled back a little bit, but it hasn't pulled back a lot yet. And we can see it has drifted back a bit, but we're watching to see what happens. So now what happens is does it trade like a tech stock where they've had a huge run and they're coming off, or does it go back to trading like an auto stock, which are starting to do really well? So we could see a bit of a tug of war in Tesla, but in the near term. But I mean, there's always a tug of war going on in Tesla. And
it's such a volatile stock, though. So it's one of those ones that I'm sure people want to invest in, but there are concerns. Would you dip in at the price it's at today?
At this point in time, just because it does look like it's come off a little bit, with a lot of these momentum kind of names, I'm just kind of keeping an eye on them right now to see how does this shake out. Have we had enough of a pullback that we'll start to find support and then work our way higher again, or do we still see the potential for a deeper correction? And the jury's kind of still out because we've had this really
couple weeks?
A couple of weeks since the beginning of the month.
Where would be the next support level for Tesla, if you don't mind?
So Tesla, having broken this 415, 420, is probably down in this. Well, there's a 400 round number, and if that, then we had a low here, probably 360 to 375 kind of support zone, 350, 375.
350, 375 after 400.
Yes.
So 400, your first support level you see, and then a drop down from there.
Yes,
Got
potentially.
It. Okay. When would you consider selling?
We would consider selling if we started to see the relative strength deteriorate enough that it was underperforming relative to other stocks.
Got it. Okay. Colin Cieszynski, thanks for joining us today. Appreciate all your advice and market call. And thank you for joining us today on the show. We'll see you back here again tomorrow.